Hey everyone, it's Justin here, America's Honest Tax Accountant from Number Crunch Nerds. In this video, we're going to walk through all the details of how to prepare a capital loss carryforward schedule, including lots of examples. Now, the reason we want to track our capital loss carryforwards outside of our tax returns is because number one, the tax return often doesn't actually show you what the carryforward is. In particular, with the client copy that your tax preparer or tax prep software may provide for your records. And also because number two, when people switch tax preparers or tax prep software programs, carryforwards can sometimes be left behind because people forget to transfer them manually to the subsequent year, which would be required in most cases. And if that happens, you're going to be paying more in taxes than you really have to, possibly for years to come. So step number one is we have to create two schedules, one to track short-term and one to track long-term capital loss carryforwards. On the left is going to be our short-term schedule, and on the right is going to be our long-term schedule. Now, step number two, we have to determine for the current year our short-term capital gains offset by our short-term capital losses to arrive at a net short-term capital gain or loss. That's what we're going to be doing right down here in this part of the schedule. Capital gain generated right here, capital loss generated right here, and then we combine those two together to get a net capital gain or loss generated for the current year. Then we're going to do the same thing over here. Long-term capital gains offset by long-term capital losses results in a net long-term capital gain or loss for the current year. Now, step number three, we need to obtain our capital loss carryforward coming into the current year. We need to obtain this for both short-term and long-term carryforwards, and then we need to net the carryforwards with the current year gains and or losses within the short-term and long-term categories. For example, if we had short-term capital gain generated of $50,000 in 2024, and we also had short-term capital loss generated of $14,000 in 2024, we would net those two together to arrive at a net capital gain short-term of $36,000 for 2024. We would then offset that with any short-term capital loss carryforward that was coming into 2024 from 2023 or prior years. The result would be the current year short-term net gain or short-term loss available right here in this case is $28,000. Now, same concept over here in long-term, except this time assume that the long-term capital gain generated was $4,000 and the long-term capital loss generated was in excess of that at $15,000. We would net those two together to arrive at a net long-term capital loss generated in 2024 of $11,000. That number would be combined with any long-term capital loss carryforward coming into 2024 from prior years, in this case $7,000, and the result of combining those two amounts would be the current year net gain, or in this case available loss, of $18,000. Now, here in step number four, to the extent that one category has a gain and the other category has a loss, which is the case right here in this example. We have a $28,000 short-term capital gain and we have an $18,000 long-term capital loss. So to the extent that that is the situation, the loss can be transferred from one category to the other until either A, the loss is exhausted, or B, the gain is wiped out. Now, the common language that you will hear with respect to how this works is something to the effect of short-term capital losses are netted against short-term capital gains first, then any remaining loss can be used to offset long-term capital gains. And the same is true going the other direction. Conversely, long-term capital losses are netted against long-term capital gains first, then any remaining loss can be used to offset short-term capital gains. So let's see if that's what we have accomplished right here. Short-term capital losses are netted against short-term capital gains first. The result of that is then netted against any short-term capital loss carryforward that may be present. That's the same thing happening over here. Long-term capital losses are netted against long-term capital gains first. That result is then combined with any long-term capital loss carryforward that may be present. And And then after all of that is complete, any remaining loss can be used to offset the gain in the other category, basically. So here we have a $28,000 net short-term capital gain. Here we have a net $18,000 long-term capital loss. All of the netting within the short-term category and all of the netting within the long-term category has already been completed. Therefore, this number right here is the quote-unquote any remaining loss. And that $18,000 can be used right here to offset this short-term capital gain, resulting in a remaining amount of $10,000 that ultimately appears as short-term capital gain on the tax return. All right, so let's hop into the actual capital loss carryforward schedule right here and do some scenario testing. All right, so there are 3 basic instructions in order to fill out this capital loss carryforward schedule. Step 1, enter the short-term capital gains and losses for the current year. That's going to be these 2 cells right here. Step number 2, enter any short-term capital loss carryforward from prior years carried to the current year. So that's going to be this item right here, and we will enter some numbers in there in just a moment. And then step number 3, repeat steps 1 and 2 for long-term capital gains, losses, and carryforwards. And we have 3 possibilities for the output. We're going to go through each one line by line, and we're going to do it with numbers. So output possibility number 1, if the result is a current year net gain for both short-term and long-term, then the loss transferred from one category to the other will be 0, and the actual amounts on the tax returns will equal the tentative amount shown above in the schedule for the tax return for both short-term and long-term. So starting right here with the simplest case, we have a $50,000 short-term capital gain generated in the current year. Over here we have a $20,000 long-term capital gain generated within the current year. In both cases, there is no capital loss generated, there is no capital loss carry forward, and so the gain will simply be reflected on the tax return. Short-term of $50,000. Short-term capital gains are treated as ordinary income and are taxed at your marginal tax rate. And we have a long-term capital gain of $20,000. Long-term capital gains are taxed at the preferential long-term capital gain rates, generally 15%. Okay, so let's see if output 1 was correct. Item A, was the loss transferred between the 2 categories 0? Loss transferred right here was 0. Loss transferred right here was 0. And that makes sense because there is no loss to transfer in this situation, so we have 0 in both cases. Item B, does the actual amount on the tax return equal the tentative amount for both short-term and long-term? So here is the tentative amount that will be reported on the tax return, $50,000. Here is the actual amount that will be reported, $50,000. So they are the same in short-term and they are the same over here in long-term at $20,000. Once we get further down into the other 2 output possibilities, it will be more clear what this column right here is for. Okay, if the result is a current year net loss for both short-term and long-term, then the following will apply. So first we have to make these schedules a current year net loss for both short-term and long-term. So I'm going to go into this cell right here and I'm going to type in a minus $60,000. And I'm also going to go into this cell right here and type in a capital loss carry forward of $24,000. Then I'm going to go over to the long-term schedule and let's put in a minus $30,000 here for the current year loss generated. And then over here in the carry forward, let's put in a minus $8,000 for the long-term capital loss carry forward. Okay, so again, in this scenario, we have a current year net loss for both short-term and long-term capital gain. So when that is the case, item A, the loss transferred between the 2 categories will equal 0. Is that the case? Loss transferred right here is 0. Loss transferred right here is 0. The reason the loss transferred is going to be 0 in this case is because you would only transfer a loss if one category had a gain that you wanted to offset. If both short-term and long-term have a loss, then there's no reason to transfer loss from one side to the other. Okay, item B, the short-term actual deduction will equal the short-term tentative deduction, but not to exceed $3,000 of loss. Okay, just to refresh this rule right here, capital loss can be used to offset ordinary income on your tax return, but not to exceed $3,000 in any given year. So when we have a current year loss right here, and we have a current year loss over here, then the combination of the amount on the tax return in this cell and the combination of the amount on the return in this cell over here, combined, those will not exceed $3,000. Now right here, if the short-term actual equals equals $3,000 of loss, then the long-term actual will be 0. That's what we have right here. Short-term actual is 3,000, long-term actual is 0. The ordering rule is that when you have a short-term capital loss available and a long-term capital loss available, the short-term capital losses will be used up first, and the long-term capital losses will remain in the carryforward until such time as the short-term capital loss carryforwards are exhausted, and then the long-term capital loss carryforwards will start to be utilized. So this is the situation currently reflected in the schedule above. We have a short-term actual of 3,000, therefore the long-term actual is 0. Now, if the short-term actual is less than $3,000 of loss, then the long-term actual will equal whatever the long-term tentative deduction is, but not to exceed $3,000 of loss combined for short-term and long-term actual, as we just said. Let's see if we can set up this situation in the schedule above. So I'm going to go up here and let's just make these numbers really close to each other. I'm going to say that this is minus 51,000, and then I'm going to make our capital loss carry forward equal to minus 500. Now, by doing that, you can see we have $1,000 of net capital loss generated for short term. There's a $500 short-term capital loss carry forward. That results in $1,500 of loss available. So this is no longer $3,000 because there is not $3,000 available. There's only $1,500 available. So that would be the maximum that could appear over here. Now, let's set up a similar situation over here in long term. I'm going to go into this cell right here and I'm going to make this minus 21,000. And let's start by just making this 0 right here on the carry forward. So here we have a net long-term capital loss generated in the current year of $1,000. There is no capital loss carry forward at the moment. So the maximum loss that could appear over here is going to be $1,000. And you can see that combined, this is $1,500 and this is $1,000 over here. So we're at $2,500 of loss being deducted against ordinary income. Now let's increase the capital loss carry forward by $100. Okay, combined right here, we're still under 3,000. I'm going to increase this by another $100. We're still under 3,000 combined. I'm going to increase this by, let's say, $5,000, and we're limited to $3,000 total. $1,500 right here, $1,500 right here. So again, if the short-term actual loss is less than $3,000, then the long-term actual loss will equal the long-term tentative loss, but not to exceed $3,000 of loss combined for both the short-term and the long-term actual. So when we look at this $1,000 of net long-term capital loss generated in the current year, and we combine it with the $5,000 of long-term capital loss carry forward, we get $6,000 of total long-term capital loss. So the tentative deduction on the tax return related to this $6,000 could be as much as $3,000. However, since we already have $1,500 over here and short-term has to come first, then this tentative $3,000 of deduction right here will be limited to whatever amount is needed right here, such that this amount plus this amount does not exceed $3,000. Now, the last item right here, all remaining loss will go into the carry forwards. So let's take a look up here at the carry forward. We generated $1,000 of loss. There was $5,000 of carry forward coming into the current year, so total is $6,000 of loss. We used up $1,500 of loss over here, and therefore the 2024 carry forward going into 2025 is going to be 6,000 less 1,500 equals 4,500. Now, assuming that nothing else happened in the future other than winding down this carry forward, meaning assuming we never generated any more short-term capital gains or losses, and we never generated any more long-term capital gains or losses, then in 2025 we would have $4,500 of loss available. We would have a tentative deduction of $3,000. We would have an actual deduction of $3,000 because there is no deduction over here in the short term. We would have $4,500 of total loss available. We would use up $3,000 of the carry forward. That would leave $1,500 of carry forward going into 2026, and then that amount amount would be used up in its entirety in 2026 because it's less than $3,000. Okay, output possibility number 3. If the result is a current year net gain in one category and a current year net loss in the other category, then item A, loss will be transferred from one category to the other until either number 1, the loss is completely exhausted, or number 2, the gain is completely wiped out. So let's see if we can set up that scenario. I'm going to go right here and I'm going to change this to a minus $31,000 instead. Now we have a gain of $18,500 in one category. Over here in the long-term category, we already have a $6,000 loss for the year, so I don't have to adjust anything right there. So let's go over item A again. Loss will be transferred from one category to the other until either number 1, the loss is exhausted. That's what we have going on in this situation right here. There's $6,000 of loss, and the full amount of loss was transferred from long-term right over here to short-term to offset this $18,500. And then this loss over here in the long-term is completely used up. There's nothing left to carry forward. The other possibility down here is that loss will be transferred from one category to the other to the extent that the gain is wiped out. So let's go back up here to the long-term and make this loss bigger. I'm going to go in here and let's make this a minus $80,000 loss. Okay, so we have a $20,000 gain, we have an $80,000 loss. That's a $60,000 net long-term capital loss right here. Plus the $5,000 of carry forward gives us $65,000 of long-term capital loss. So now the loss will be transferred under item 2 right here to the extent that gain is wiped out. So of the $65,000 of loss, $18,500 will be transferred, and it will offset this short-term capital gain completely, resulting in nothing to be reported on the tax return for short-term capital gain or loss. Now back over here on the long term, we had $65,000 of loss. We transferred $18,500 out, but these two numbers combined are still well in excess of $3,000. So our tentative deduction here on the tax return is going to be $3,000, and our actual deduction is also going to be $3,000, again because there is nothing over here. Now down here, item B, if gain remains, it will be reported on the tax return. This is what we just saw in the previous scenario when the long-term loss was $21,000. I will switch it back to that in a moment so we can review item B. For the moment, let's just look at item C. If loss remains, it will be reported on the return not to exceed $3,000 of loss, and the rest will go into the carry forward. So right here we had $65,000 of loss. We used up $18,500 of it to offset the short-term capital gain over here. We took $3,000 of it on the tax return as ordinary income. So $65,000 starting point less $18,500 less the $3,000 right here results in a 2024 long-term capital loss carryforward to 2025 of $43,500. Now let's go ahead and switch this number back to minus $21,000 so we can see that other result. And the other result in item B was if gain remains, it will be reported on the return. So in this scenario, the full $6,000 was transferred over to short term. It offset this $18,500, but not completely. So there was $12,500 of gain remaining, and that $12,500 is what will be reported on the return. By the way, I just placed a downloadable copy of this capital loss carryforward schedule in the members area of my personal tax planning template program. If you would like to engage in tax planning, if you would like to minimize your tax burden over the course of your life and maximize the after-tax cash flow that remains in your family's pocket, you can check out multiple demonstrations of how the personal tax planning template works within my Roth IRA conversion video series on YouTube. Within that series, we discuss numerous tax planning issues related to capital gain, dividends, taxable and non-taxable interest, Tax Cuts and Jobs Act, Social Security, widow's penalty, IRMA, net investment income tax, and so much more. To find that video series, just search on YouTube for Number Crunch Nerds, Roth IRA Conversion, or check out the links to the series in the description below this video.